Hello, friends. Welcome to the Weekend Investing Daily Byte of 6th of January. And today we are going to talk about the fall in the markets. Is a bigger fall possible now? I think the worst fears are coming true. All the bounces that we have been seeing in the market have been given up. We are at a very, very crucial neckline in the charts. I'll show you that in a short while. But it does seem like that the market is gearing up for something deeper on the downside. Let's see what the charts are telling us. Let's also read the disclaimer and subscribe to the channel if you haven't so far. So this bounce that we had recently last Thursday has been completely given up. So this attempt to pull back up just managed to close this gap, and immediately on closure of this gap, the market has fallen down in two sessions and eroded more than what it gained in those two up sessions. So we are again at a near 23,500, 23,600 levels, which was the level initially achieved by the first leg of the fall. And then we had a bounce, a higher low than the previous one, and then we were bouncing into the next high, but this has been abruptly immediately ended. uh, this level of 23,500 around till 23,250, this range still has support here. I would not say that this would easily go away, but if 23,250 gets taken out, then of course a lot of investors who will buy or sell basis some levels will come and sell the market. That will create even more pressure on the downside once if this level breaks. Market in the last two session itself on a very short term basis is oversold. So a pullback after a gap down or a quick retest of this level is also not out of the bounds right now. But yes, the hope that this leg would have built up has been dashed, and we will now again need to find a bottom somewhere, consolidate, and then come back up again. So the recovery definitely is delayed now. Minus 1.62% on the Nifty. Nifty next 50 was not as lucky as Nifty, and it was smashed down 3.1%. So we are on the Nifty next 50, we are already near the mid-November lows, and this chart obviously is not looking pretty at all. On the mid cap front, a big gap down, a gash down on the charts, 2.52%. So this is sort of now continuation of what was happening this about 8 or 9 days ago, and a similar candle has come here. There is a gap here. There is good likelihood that you will go down, fill this gap, and try to find some bottom here. That now looks quite possible on the mid caps, minus 2.5%. Small caps also losing more than what it gained in the last 7-8 sessions in just one stroke, 2.88% down. And this entire rise from mid-November, more than half of it is already gone. And most likely than not, some more will also go, minus 2.8% on that. Bank Nifty, you can say, is the leading indicator of, or the leading chart here, where we are already challenging the November lows and also the August close here. So Bank Nifty is a terrible chart, I would say, versus others. But then again, Bank Nifty is also in the oversold zone of the charts right now. So momentum trends, advances are virtually 45 versus declines at 455. So 10 is to 1 kind of ratio of decline. So very few places to hide today. Heat map is completely red. Reliance down 2.6%, and this on the back of news that Jio will come out with an IPO this year. Coal India down 4%, Trent 4%, NTPC almost 4%, Power Grid. ITC, of course, this is the demerger of ITC hotels that is happening. So part of this fall was due to the stock going ex demerger. But even then, I think the expected was that ITC price should fall by about 4 or 5% due to the demerger. So it has fallen effectively about 3% more than that. Mahindra also down 2.6%. HDFC Bank, which probably set the cat amongst the pigeons by its growth outlook and its numbers on the weekend, down 2.21%. Also, a lot of public sector banks came out with their numbers and their narratives, and they were all sort of playing along in terms of the weak outlook, in terms of deposit growth and poor credit growth. SBI down 2%, Kotak Bank down 3.2%, and so on. Nifty next 50 washed with red again. You can see LIC, IRFC, DLF, REC, Lodha, PNB, PFC, Zomato, Indigo, Vedanta, VBL, Adani Power, all down around 3 to 4%. Mothersons, Havels also down. BHEL down. No place to hide. Couple of stocks that managed some green was Godrej CP, and LTIM was flat for the day. Bank of Baroda and Bank Bajaj Holding were down by more than 5% on this. So what is happening is that market is looking for a new equilibrium. What we were earlier gauging to be a equilibrium point has not stayed, and now market is looking for a new equilibrium. And IT stocks are the only ones which sort of bucked the trend here, minus 0.1%. Everything else was down 1, 2, 3, 4%. PSU banks hit the most at minus 4%, PSEs at minus 3.6%. So it does seem like that the market is not even willing to wait for the budget to smash some of these stocks. Already, some of these stocks have gotten really badly smashed. This changes the picture of the 1 week that we had, which was primarily all green till a day back, and now it is primarily all red. Autos still eking out 3.1%, but were down by 2.2% for the day. In just the last 1 month, PSU banks have now lost cumulatively on the index 11.2%. Metals are down 10%, public sector enterprise 8.7%. So the gashes have been quite deep. And on 3 month basis, you even have 17.5%, 16% losses on energy and metals. So quite a remarkable takeaway from where we were 3 months ago. And you can see the public sector banks that have been smashed down. And probably public sector banking index is the only index which is now again below the June 4th election day low, which has been a low which has held for many other indices as well as the Nifty. But and we are still far from that on many indices. But PSU banks is sort of leading the charge below this level, and looks like a lot of distribution and then some collapse happening here. Minus 7% on Union Bank, 5.6 on Bank of Baroda, 4.6% Bank of India, Bank of Maharashtra, IOB, Punjab Sind Bank, all regardless of where their numbers are. If they were PSUs, you will get smashed. On the portfolio momentum score report, we see what is the momentum score of the stocks that you hold. You can do this health checkup if you like. Another large cap stock that has very low momentum score, and we are highlighting low momentum scores here, is Adani Power. Is down from nearly 900 rupees to 496, and very low momentum scores would be the ones that you want to get out of the first amongst your portfolio. So in momentum portfolios, obviously those with the highest momentum scores remain in the portfolio, and those with lower momentum scores will get out first. Either these strategies will go to cash, or they will rotate into the relatively higher scores. It could also be a position where, let's say in Nifty 50, all stocks are having lower scores, but even amongst those lower scores, the best few will get chosen to be there in the relative terms. So by having this score, you can sort of make out which stocks you should be able to get out, or if all the stocks in your portfolio, whether they are healthy or not. Since June, this has dramatically gone down versus the large caps. So large caps are still flat versus June, whereas Adani Power is down 43%. The discussion for the top, for today is whether a big fall is brewing in the market. So let's discuss that. So we've had now the third attempt at the breakdown of the 200 DMA. You can see the first attempt was here, and then the next attempt was here, and we pulled back up, and this is the third attempt here. When you keep pushing against some resistance, it usually gives way over a period of time, mostly. So this is also the first time that we are seeing a 10% plus correction since the top that we made here. Um, a move below this particular support line probably will confirm that we are in for some rough start of 2025. Till we break down below this level, I would still remain hopeful that some turnaround may happen. But after three falls, usually the market's back will break and it will go somewhat lower. In my mind, worst case scenario is somewhere near uh, the election day low. I don't hope we go there, but if we do go there, then you should be mentally prepared for that kind of an outcome. Below that, of course, nobody is prepared for that, but rationally, you should be prepared for that. Uh, in the past, we've had a lot of 10% plus falls. Uh, we've documented the last 20 years. You can see there are so many of them when market fell more than 10%. But the end result of that is that if you remained allocated in the market, and if your strategy was able to churn into uh, stocks that are winning, are recovering, then you would have this equity chart. This is the Nifty chart, but your equity chart could look better than this if you were if you do two things: stay in the market, don't run away from the market, and two is to make sure that you don't get stuck in stocks that don't recover. That is the most key for a lot of portfolios, where people think that, okay, I'll stay within the market, but the 10-20 stocks that I've bought, I'm going to wait till they come to my buy price or till they get some profit. That is the cardinal mistake that a lot of folks will make, because in every subsequent rally or a new bull run, the same set of stocks will not perform. So, if IT stocks performed in 2000, they're performing now after 20 years of in any big way. If infrastructure stocks were performing in 2004, 5, 6, 7, they are now performing in some big way. Pharma was performing in 2011 to 14, 15. It is now started to perform again. So the cycles of different segments of the sectors are going to be different. So don't expect the basket of stocks that you bought, when the market goes down, the same stocks will come back up. That won't happen. Not immediately. Maybe they'll come up later, or some may never come up. So if we were to tabulate all these falls of 10% or more, you will see that while there were some exceptional falls, like 60% in the GFC crisis in 2008, 38% in the COVID crisis in 2020, most of the other falls would be between 10 and 20%, or maybe 10 and 25%, you can say, on average being 22%, but it also has these bigger falls as part of it. So about 20% is the max sort of drawdown that you would think that could happen rationally. Now, out of these 28 sessions, uh, uh, only you can say 2 or 3 times did we go beyond 25%. And the recovery from these bottoms, where complete loss was recovered within on the index at least, and your strategy may perform even better than that. Uh, in almost all cases, barring the deep ones that we had, you would see a recovery in 3 to 4 months. But on an average, when we see everything, it's 244 days, which is about a year. So, in your mind, you should be prepared that this entire fall that we are having, even if it bottoms today, we will take a year to recover, or maybe 9 months to recover, because we have been falling for 3 months. That is the sort of base case that you should work with. And this recovery is not just for the amount you are invested already, but the amount that you are continuously investing, that will also recover a very quick recovery of your overall portfolio. So this is basis one time investing, but when you are gradually bringing in your money, that recovery will happen very, very fast. So that is something that you want to keep in mind. uh, More on this. So the number of average market days for 10% fall has been 28 days. So in this the periods that we have taken from 2005 to 2021, you can see that more recently uh, the number of days to 10% fall have been higher. The average max drawdown in all 10% plus is 22%, as I already showed you. So you can see that most of them are below this average line. Only exceptional ones are above that. So expecting anywhere between 10 to 20, 22% is something that should be there. And the average recovery period usually will be 3 to 4 months. In some cases will be more and will get extended to higher recovery period. So from a all knowing the history and knowing that the market always recovers, there should not be any panic. First of all, whenever you come into the equity market and into direct investing, a 3 to 5 year view is something that we always tell you that you must have. So if you've come in very recently, let's say 3 months back, you are sitting with the maximum pain. There is no doubt about that. You may be down 10, 15, 20%. If you came in, let's say a year back, you've lost some money, but it's not that you are still negative yet for the year gone by. So you can take solace that my capital is still intact. If you came in 2 or 3 years back, you are still sitting in very good comfort cushion that has been built on your capital. Yes, you've lost money from the top, but then markets, as you've already seen, if you are in the market for 3 years, that market returns are lumpy. There will be some very good years and there will be some bad years. Maybe this current quarter and this year is going to be a bit rough. That is the thought today. But 2 months later, there may be some changes in the market that may, you may completely forget about this period totally. It is very, very much possible because markets change the trends in very, very quick manner. And it's only because you are concentrating on today that will give you pain in your mind. But if you were to look at a longer picture, that will get distributed across. So if you look at 1 year, 2 year, 3 year behind, you will see that where you were, you've come a long way from there. And the same way will happen in the next 2 3 years. So if you stop to focus about today, that I've lost this much money today, it will take your mind towards that larger picture that needs to be built. So the correction is important. That is also very true, because it's an opportunity to remove the excesses from the market. There are always excesses that get built in pockets. uh, Weekends, hot money, all that needs to be removed. uh, you have an opportunity that has been given again to identify stocks or to add more capital to the stocks that you like, or do better than the normal average investor who will run away at the drop of the market. You don't want to be that. See, most people will not make money in the market, it's a fact. But if you want to make money in the market, you'll have to stay and bear the pain. And that pain you're bearing is the reason why you're getting that premium returns over by taking that risk. It's a great opportunity for rupee cost averaging. So if you keep on allocating money, gradually you will see as the market trend turns, whenever it does, all that will start to work for you effectively. And after every fall, we've done many studies on this. There's a brilliant correction that recovery that is waiting to happen. So you need to embrace the falls with the view that yes, there is going to be a pot of gold at the other end. So do mention in the comments how are you coping up with the markets. Are you adding in this correction? Are you exiting and closing your portfolio in this correction? Are you trying to time the market? Do mention in the comments. And thank you so much for watching. Do like and share these videos if you like the content, and do subscribe to the channel. Thanks. Bye.